These are the trades I took using the same method I just explained. Both GBP USD and Euro USD are currently in profit. This is the power of understanding price action deeply. Not just memorizing patterns, but knowing why they work and when to act. Now let's paint the picture. Let's say all of your conditions are perfectly lined up. Number 1. You've identified the 1, 2, 3 market structure. Number 2. You're sitting at the third touch or a key zone. Number 3. Your sequencing is clean. You've already done the work. Now you're just waiting to execute. All right, let's get into it. To really master your entries, you need to go beyond just spotting setups. You need to understand the deeper logic behind the structure of price, because that's where the edge is. So in this video, we're going to break down something important that helps you stay ahead of the market, the insurance entry, and how it relates to what we call the override. You're going to be dealing with different kinds of market behavior, channels, continuations, and reversal structures. These are part of the entry models we've covered already, but there are some situations where things just don't play out as clean as we want. And that's where this concept becomes important. Let's rewind for a second and think about a classic 1, 2, 3 entry model. Normally, you'd be waiting for price to tap that third touch of a trend line or structure to confirm your risk entry. But here's the thing. Sometimes the market doesn't give you that third touch. Instead, it rejects earlier, usually from a double top, a liquidity grab, or some sort of minor structure level that aligns with a bigger picture zone. And this is where the override comes in. The override is the point where price doesn't complete the textbook 1, 2, 3, but gives enough reaction and confirmation to justify an early entry. It's a rejection zone, often at a previous high or low, where price makes it clear. I'm not going any higher. Let's turn this thing around. So rather than sitting there like a statue, waiting for that clean textbook setup, you start preparing for the insurance entry. All right, let me give you a mental picture. Let's say price is trending up, higher highs, higher lows, and you're waiting for a third touch of the ascending channel. Price gives you the first and second touch, comes down for the pullback, and you're expecting that final tap before the move continues. But instead, price comes up short. It doesn't reach that trend line. Instead, it forms a double top just under the third touch and starts rejecting hard with aggressive candles, maybe even a bearish engulfing. That's your override. The third touch never came, but the market gave you a signal, a valid one. So instead of missing the move or chasing late, you use an insurance entry. But, and this is important, you're not just jumping in for the sake of it. You've got a reason, a reaction, and a story. You've seen rejection at a key area that fits your bias. That's what separates a calculated insurance entry from a random one. So the insurance entry helps you adapt when the market doesn't play by the book. It allows you to stay in control instead of being passive or reactive. You're not hoping for a perfect setup anymore. You're reading what the market is telling you right now, and you're responding with confidence because you understand the logic behind the price movement. Just remember, an insurance entry only works if the override is valid. That means proper rejection, context, confluence, and momentum. No confirmation? No entry. So let's say, for example, you're working with an expansion structure. You get your point 1 and point 2, and you're expecting a clean third touch to complete the structure. But that third touch just doesn't happen. Instead, price reacts early, and that early rejection becomes your override zone. Now, this override is usually found at a double top or double bottom, depending on whether you're selling or buying. In this case, let's say we're looking for a sell, and we get a double top formation instead of that expected third touch. This is where the insurance entry comes into play. Rather than forcing a trade or taking an entry without confirmation, you wait. The override tells you, okay, we might not be going for the third touch. The rejection is already happening here. But you're not just selling off that first rejection. You're smarter than that. You're waiting for confirmation. The insurance entry logic. So imagine you're on the 1-hour time frame. You were waiting for that third touch. It never comes. Price rejects early off the override and then forms a continuation structure, maybe a flag, a wedge, or a mini consolidation. That right there, that continuation after the rejection, becomes your insurance entry. The idea behind the insurance entry is this. You're entering in an area that's less confirmed, but you're not going in blindly. You're waiting for the first continuation after the initial rejection. That continuation adds the confirmation you need to execute the trade with confidence. Now, you can approach the insurance entry in two ways. Number 1. Risk entry. You take the trade within the continuation structure, ideally from the top of that range. Your stop is placed just above the structure, and you target the low, or the next key level in the trend direction. This gives you a better risk to reward, but it's slightly more aggressive. Number 2. Reduced risk entry. Instead of jumping in right away, you wait for the break of the continuation structure. You enter after the break and retest, which gives you extra confirmation, but your stop is usually wider. It's more conservative, but safer, especially if you're trading larger time frames or higher volatility pairs. The insurance entry is one of those tools that helps you adapt when the market doesn't give you textbook setups. You're no longer stuck waiting for a third touch that never happens. You're reacting to what price is doing right now and using structure to make smart decisions. Just remember, the override is less confirmed, so the continuation is key. Don't just enter because price touched the level. Wait for price to show intention, then step in with either a risk or reduced risk approach. All right, let's jump into my MT5 real quick. As you can see, these are the trades I took using the same method I just explained. Both GBP USD and Euro USD are currently in profit. This is the power of understanding price action deeply. Not just memorizing patterns, but knowing why they work and when to act. Now listen, one of the biggest problems with modern traders is this constant need for instant results. Everyone wants to flip accounts overnight, and when they don't see results fast enough, they quit. The truth is, it took me over 3 years before I started seeing consistent progress in my trading. Maybe that's because I was a lone wolf. I did everything on my own, learned through trial and error, with no one to guide me. But you don't have to go through it the hard way. If you want to shorten your learning curve, I invite you to join my mentorship program. I'm not here to sell you dreams. I'm not promising instant results, because that depends on you. But what I can do is set you on the right path, with structure, clarity, and real trading guidance. The link to join my free community is in the comment section below. If you're serious about learning this game properly, I'll see you inside. And that's it for today's breakdown. I hope you picked up something valuable. If you enjoyed this video, smash that like button, drop a comment below, and subscribe if you haven't already. I've got more content coming your way, from trade breakdowns, strategy insights, to full-on market psychology tips. Until next time, stay patient, stay consistent, and trade smart. Peace.